What's up, everyone? Welcome to the daily macro update for Monday, August 25th. Taking a look at some of the macro data here today. Hopefully, you guys can hear me. I know we were having some technical difficulties with the audio last night for the Sunday macro wrap up, but we got a couple of pieces of data today in the macro news cycle. So, new home sales as well as the Texas manufacturing sector both coming in easier or slightly lower than what was anticipated. We'll get into that as well as the heart of the update today, which is with this recent decline in Bitcoin as it relates to the central bank liquidity also declining. All right, first let's take a look at the new home sales easing. Taking a look at the nominal number here, you can see that it's pretty much a little bit unchanged or little changed from June into July, right around that 650,000 units being sold. Of course, when taking a look at this, you want to make sure that you're, looking at the year-over-year rate of change, not just the nominal number there. And so if we take a look at that change right now, you can see that, let's just go ahead and zoom in here, that we remain in further negative territory. So the number of new single-family homes sold in the United States, the annual rate is at negative 8.2%. This has remained negative pretty much since January of this year. It was going back and forth between negative and positive, really since, beginning of 2024. And there are periods where it does go negative, right? I mean, even pre-pandemic, we saw that there are cycles of the year where it does go negative, but you really don't see it sustained for more than a few months. And so, yeah, I mean, we could see this continue to worsen as we go forward here. What's interesting is that the average price of a new, or the average price of houses sold in the United States remains near all-time highs. So again, the Fed is cutting interest rates while the average sale price of a home is north of $500,000. This is, about 70% higher than pre-pandemic levels. But when you take a look at the year-over-year rate of change, you can see that this has pretty much remained, kind of near where it was at historically. But yeah, I mean, some people, I posted it on my Instagram story today, how the irony of people celebrating rate cuts is that home prices are just going to continue higher from here. And the reason being is because when you lower interest rates, this causes financial institutions to be able to lend more, which in turn increases money creation, and that in turn accelerates inflation. And so with the Fed easing here, while prices near all-time highs, I mean, I wouldn't be surprised if the average price of a home, continues to accelerate here. So yeah, I mean, that's what I'm looking at here in terms of the average prices. Let me see. For the average price of a new home is slightly lower than the average, nominal price of average homes. That's at 487,000. Monthly supply of new houses is around 9.2 months, which is pretty high. I mean, really, the last time we saw this was near July 2022 levels, and then before that was in February of 2008. So housing supply still, or month supply still, accelerating here. New single-family homes or new single-family homes for sale in the United States, that supply continues high or higher to levels that we haven't seen since October of 2007. And so, yeah, I mean, you're just continuing to see a housing freeze. And guess what? Even if they do cut by 25 basis points, Fed funds is going to remain at 4%, and maybe you get housing 30-year fixed mortgages near around 6% to 6.25%. So you're still not getting the relief that you might think would happen for the Fed cutting rates, because they're still uncertain about inflation. But moving over to the Texas manufacturing sector, this had a slight contraction into negative territory there. When we take a look at prices paid, that continues to accelerate due to tariffs. And then, more and more, there's a higher percentage still of Texas manufacturers reporting those increases. You are having new orders get back into positive territory from deeply negative back in April of this year. And so you're having a little bit of a recovery there. And then the employment index is also having a recovery for the Texas manufacturing. So that's actually good news. And so the big catalyst this week is NVIDIA earnings on Wednesday, I believe. Let me see, the 27th. Yeah, that's on Wednesday after hours. So, NVIDIA, largest stock in the entire world, largest one in the United States. That's a big deal. That's the big catalyst this week. And then in terms of inflation expectations, the Cleveland Fed continues to show that core PCE, which we get this Friday, is going to continue to accelerate. Core PCE is the Fed's preferred inflation gauge. And so they have that rising from 2.8%, where it's at currently, to 2.9% in this recent print this Friday, and then going up to 3.0% for the August print, which comes out at the end of September, right after the September FOMC press conference. And so when we take a look at the target rate probabilities, you still have an overwhelming majority vote in the futures market saying that the Fed is going to cut rates by 25 basis points by 86%. This is right after you had a large celebration and shift from about a 70-30 to now in nearly a 90-10, right? And so that was right after last week's Jackson Hole Symposium speech by Jerome Powell. All right. Taking a look at Bitcoin, though, this is something that I have my eye on. Really, Bitcoin is a great proxy for central bank liquidity. And the reason why I like to look at this as well as central bank liquidity is because let me just hollow out the candle chart instead and use bars. And then let me go ahead and actually let me go and copy this chart here. This is net central bank liquidity. Let me go back up to Bitcoin. Okay, there it is right there. Pow. This wording is in the way. Let me see if I can. Oh, the wording is going to have to stay there. But interestingly enough, let me make this white actually so you can see it better. All right, so net central bank liquidity is here in white. That's around $1.71 trillion. And, at the same time, as this has been decelerating, about $360 billion has been removed from net central bank liquidity from mid-July. And that was also right around the time where Bitcoin stopped going up, right? And so I do think that Bitcoin closely follows this chart. It's not a perfect 1-to-1 ratio, but I mean, when you go ahead and you zoom out here on a long enough time frame, let me go ahead and make the Bitcoin chart here. Yeah, so I mean, you can pretty much see Bitcoin and this net central bank liquidity chart, pretty much follow each other pretty well, right? Again, there are times where, Bitcoin might front run this or, lag it. But in a general sense, as net central bank liquidity increases or decreases, so does Bitcoin, right? As you can see all the way back here during the bear market of 2022, You had net central bank liquidity just completely start to decelerate back in October of 2021. And then it continued to make a series of lower highs and lower lows before it really started to drop off around the end of December of 2021, which is right around the time when Bitcoin officially entered its bear market, right? And so this metric here, especially post-pandemic, is incredibly important to track. And it is no surprise right now how we continue to see net central bank liquidity weaken, and in turn you're starting to see Bitcoin weaken as well. Now again, like during this time here from the end of February to mid-April, a lot of this large acceleration was due to the tariff scare. So there can be times where you see a large acceleration in net central bank liquidity, and that'll actually front run the move in Bitcoin by about, let's see, that started to really accelerate throughout the month of March, and then you didn't see that translate into Bitcoin until really the month of May. And so there was a little bit of a 2-month lag between net central bank liquidity and Bitcoin there. So definitely interesting, seeing that there. But pretty much the main driver of why net central bank liquidity is starting to decline here is because of the increase in the Fed's Treasury General Account. And so whenever this number here starts to accelerate, that's typically since this is a liability on the Fed's balance sheet, when this increases, that means that's liquidity coming out of the financial markets essentially. And so they're trying to get this up to 800 billion, I believe, by the end of September. And so that's $300 billion that's going to have to continue to be removed from the financial system. And guess what? They were using a lot of what was left in the reverse repo facility in order to fill that up, right? Because right back here, essentially, well, actually, let's go back to, so the beginning of July was when this started to rise. And then when we go back to the beginning of July of this year on the RRP, that's really when this started to really decline, near back down to where it was at right before its large acceleration in March of 2021. And so it's near zero. And yeah, I mean, that's pretty much nearly all drained. And so the powers at be, right, the central powers, both the central bank as well as the government, are running out of pockets of liquidity in order to raise cash. This is partly the reason why you see a large push by this administration with stablecoins, because if they are able to pass that, or I think they did already pass the Genius Act, guess what? All those stablecoins are now having to be backed up by treasuries. That creates a lot of demand for treasuries. And so as the usage of stablecoins goes up and the popularity of crypto goes up, guess what? So does demand for treasuries, which allows the government to remain funded. And so, for a lot of people who are just looking at, progress with cryptocurrency legislation, yes, that's part of it. But also, too, the government just isn't doing that because it wants to do what's good for the American people with cryptocurrencies. They're using it for their benefit in order to attract buyers to their bonds, to their debt, right? That's the reason why they're doing this. So always have to read between the lines, ladies and gentlemen. There's always a reason why the government is doing it. And it is normally, actually not normally, it is always within the context of self-interest. All right. When we take a look at bank reserves, they're looking to decrease these as well, which would also continue to decelerate this net central bank liquidity dynamic. And so, we've been talking about this for the past few weeks, at least, in our group. And so, yeah, I mean, you could continue to see some headwinds from this on Bitcoin itself. So that'll be interesting. But yeah, Bitcoin, for a lot of people who are, bullish on it, which I am in the long run, definitely. because the government is just going to keep printing money. But there are times where liquidity has these minor contractions, and during those times, Bitcoin really has trouble keeping up with the markets there, or at least it has trouble with going up. And so, yeah, that's what I'm seeing with the risks in terms of cryptocurrencies. And so from here, we can go ahead and take some questions. All right, let's go ahead, take a look at YouTube here. Matthew Wright says he subscribed to the course about 5 minutes ago. Looking forward to the profits. Awesome, Matthew. Great to see you in the group, man. If you have any questions, just reach out to myself or my team. We're more than happy to support you as you go through the training modules there. All right. All right, no real questions in Instagram. It looks like people are just chatting in there. All right, let's take a look at TikTok. How's it going, everyone? How we doing? Let me just go ahead and scroll through some of the comments here. Inflation data before the meeting will come in even more elevated. Yeah, it should. And you have Alibaba and Snowflake this week. Yep, that's true too. The GDP revision for Q3 or for Q2 won't be super impactful or as impactful as it was the initial reading. But yes, we do have that, I believe, on Wednesday. Appreciate the follows and the shares. All right, so yeah, if you guys have any questions here, just leave them in the chats below. But I do believe that if net central bank liquidity continues to decline more, it's going to be just added headwinds with Bitcoin. So yeah, and we're also starting to see Bitcoin volume accelerate here. So ever since it topped out on lower volume right here on, when was that? That was on August 13th, new all-time highs. That was on lower volume, which was a bearish divergence. So that was like a huge sell signal. And then as prices have dropped since then, you've been having that on accelerating volume, which is bearish, right? So when prices decline on accelerating volume, that is, typically a bearish sign. And so what I'm looking for is for, volume to decline on price decelerations, which we're not yet having. So a little bit of a wait and watch here with Bitcoin. It did go neutral in our model, which is a bearish rate of change. We're not totally bearish on Bitcoin just yet, but, going from bullish to neutral trend is definitely not the direction you want, especially if you're someone who is, wanting to be bullish on Bitcoin here. Interestingly, Bitcoin dominance is having a little bit of a pop today, but it still remains in a clear bearish trend. Most of the flows is heading towards Ethereum, which is having finally a decent sell-off day, which, Ethereum and Ethereum-based tokens continue to perform well. Can you tell us some about the expectations of this Friday's news on how I should present itself? I'm not sure what your question is. It's a little bit hard to read your question there. If you could, maybe you're not from the United States or English isn't your first language, but if you could just take what you're trying to say and throw it into like ChatGPT and translate it and then paste it in here, then I'll be able to answer it better. Do you have any resources that track discretionary spending? Well, I mean, if you're looking at macro data, it would be like durable goods orders, as well as if you want a weekly update, there's the Redbook retail sales numbers. Those are pretty volatile though. Um, but the my favorite metric that I like to use, that's more of a real-time price indicator, is the ratio between consumer discretionary and consumer staples ETFs. So it's XLY over XLP. And as you can see, whenever this ratio accelerates, that's typically more of a risk on environment, right? When discretionary is accelerating versus staples, that's typically when you have a risk on environment. So, yeah, I mean, this, if you want to just look at like a real time price chart, this does the job pretty well. But yeah, if you're looking for actual macro data, durable goods orders, Redbook retail sales, regular, retail sales, personal consumption expenditures on the services side, that sort of thing. I actually noted that XLY was bullish against staples and looks like a reversal of XLY and XLP here too. Not really a reversal. I would just say a continuation of this bullish trend here. But yeah, I mean, interestingly, staples is having a decent drop off here, back to a neutral trend from bullish. So that's definitely interesting. But yeah, still in a definitely risk on environment, that's for sure. But things could be turning here. We'll see. Still bullish on the S&P 500 Qs and Russell 2000. One thing that we like to say is that sometimes these super risky things go up at the very end of the cycle. So you might be able to see that happening too. Who knows? But we're definitely getting some similar signs of 2021 with like Ethereum and some of these altcoins continuing to rise. Um, but yeah, my bad. I was typing too fast. I was talking about core PCE. Yeah, I mean, like I mentioned before in the beginning of this live stream, core PCE, the market has that accelerating for the next 2 months to 3.0% from 2.8. So, yeah, the Fed is cutting into core PCE, their preferred inflation gauge rising. So, hopefully, hopefully they're right with Jerome Powell saying that inflation is just a one-off move, or they're just completely ditching the 2% target, which that's a risky thing to do. You're playing with fire there. Let me just take a look at the 10-year bond yield. Let's take a look at yields right now. What happened to the dollar today? A little bit of a dollar recovery. Still in bearish trend though. We have a little bit of a rise in yields. Bond yields remain in bearish trend, which means bond prices are in bullish trend. Things like SHY, IEF, and mostly the short end to the mid end of the range, or of the yield curve, remains in bullish trend. And then you just continue to have VIX at incredibly low levels. So Friday and today were great profit taking days in order to raise some cash to buy lower. So we'll see what happens. But yeah, I think for me personally, the biggest signal right now that's happening is this drop in Bitcoin. Thank you. We would want to see it lower than expected, correct? It depends. I mean, the thing is that with inflation, um, do you know when inflation really starts to go down? During recessions. So, um, yeah, I mean, if inflation starts to go down by too much, that could actually be pretty worrisome for the entire economy. So, what you want to be looking for, wow, look at this drop in Bitcoin right now. What you want to be looking for is the steady disinflation of, or steady disinflation. What you don't want is rapid disinflation and then potentially going into a deflationary environment, right? That's where you start to not go the right way in terms of inflation coming down. I'm trying to understand more of the macro to position myself better in the long term. That's great. Yeah. Welcome to the channel then. You know, that's what we end up doing. Although, this is a macro based channel, we don't position ourselves just based off of what the macro is doing, right? We want to make sure that we use the macro in order to confirm some of these medium to long term trends, but we aren't like the trends on the charts, take priority. Because again, we're not here to try and be right or be like, Michael Burry making calls on, shorting the market when things are in a bullish trend. We're not trying to do that at all. Because again, like the goal here isn't to be right, to be like, oh, look, I just made a good call. Look at me. It's, I have this money that I want to make sure outcompetes inflation at the very least. And then also, too, when looking at by the time I retire, or maybe you're someone who's close to retirement, you don't want to lose money. Because if you're young and you have maybe a few more decades left in the markets, you have to picture in your brain this exponential curve from right now to the time that you retire. Let's say that you're 30 years old, or let's just say you're 25 years old. You have what, another 35, 40 years left in the markets, God willing. And so you might think to yourself, oh, I can take out as much risk as possible, which, you could definitely lean more on the riskier side of things because you have so much time. But you also have to think to yourself, where do I want my wealth to be by the time I retire? And there's a lot of different compounding interest calculators that you can use. Figure out the one that you'd like and then stick to that curve, right? Because one bad down year could cause that curve to slope more downward or flatten, which if you extrapolate that by the time you retire, decades from now, could mean the difference of a couple $1 million even, right? So even if you're someone who's younger, you do not want to disrupt your compounding interest curve, right? That's the big deal. And then if you're somebody who is closer to or even in retirement right now, and maybe you do have a sum of money and you're just trying not to lose it, well, the big thing is avoiding drawdowns. And in this post-pandemic environment, um, gone are the days where you can just, blindly throw money at the markets and, things will go up. Even though the past couple of years have been great returns, way above average, that's not gonna be, or it's very unlikely that those returns are going to keep happening from here year over year, right? And so, in this post-pandemic environment, I think we're going to have higher than average interest rates, higher than average inflation. We've already been experiencing that. I think that's going to be continuously, being a theme for this decade. And in that type of environment, you really want to make sure that you're actively managing your funds appropriately, right? I think that active management is going to be becoming more popular, on the onset of all the technology that's out there with having access to the markets with Robinhood. You don't need to have a broker that you call up to buy a stock anymore, right? This isn't like, the 1990s or even early 2000s, right? There's a lot more retail have access to the markets these days. And so with this growing technology, a lot of people are figuring out that they can manage their funds way better than any type of financial advisor or wealth manager who They just get incentivized by the fees that they collect every single year. Some of them are performance based, and they're actually great fiduciaries. Not taking that away. If you have a good wealth manager or you have a good financial advisor, definitely keep using them. It's not what I'm saying at all. It's just a lot of people are finding out that they could manage it themselves because it's their own money. Nobody cares about your money more than you. So um, I just highly recommend that people, explore that a little bit more. Are you a day trader, swing trader, long-term investor at Macro Optics? You can be all of them, which I am, right? So I have my retirement account, and then that's separate. That's tax-free. That's separate from my brokerage account. My retirement account, like I said, that's in the back of my mind, um, that long-term curve, that compounding curve that I don't want to disrupt. But then I also have my brokerage account. That's more of a short-term trading account. And I'm not day trading in there. Sometimes I make daily trades or intraday trading, depending on if there's opportunities there. I might make a few trades of those per week in there, but that's really just a supplement to, it's like a bonus each year for my income, right? So you can have both at the same time, right? A lot of people like to label themselves a day trader or only a long-term investor. You don't have to do that. You can be both. Have two accounts. You can do that. So, yeah, you can do all of them. One last question. Would you be interested in a podcast? I mean, if you want to send me details, you can just shoot me a DM. But I mean, yeah, I mean, if it's a good discussion, sure. Do you have any high growth utility stock suggestions? We have some that are in our group, sure, but those are reserved for our members there. Are you buying the dip in Ethereum? Right now, ETH, it is having a decent dip. It's not quite at the low end of the trading range just yet. And you're also seeing this on accelerating volume, so I might give it a second. But yeah, this is definitely one where I would want to be buying dips. I mean, it just posted a new all-time high, so maybe you want to give it some breather, you know, um, especially with volume starting to accelerate here. So we'll see. But yeah, it's definitely on the list. All right, let's see. Meme coins are dropping heavily with low volume. Is that a good sign? Not necessarily. That could just be total interest leaving. What is the real goal of the Clarity Act? I'm actually unfamiliar with that legislation. I'll have to read up on it. I have Schwab and a 401k. Great. Perfect. Meme coins are dropping. Oh, yeah, you already said that. Yeah, I mean, jackhammer, I mean, it might be a sign that interest just is leaving. Who knows? But, you know, I don't trade meme coins right now because that's not what's in bullish trend. Yeah, no problem, Joshua. Uh, Bali Quintero. Do you have a newsletter? Yeah, we have a free newsletter. If you just go to the link in my bio there, we have our daily index ranges, which is a free daily newsletter where we go ahead and send you our trading ranges for both the SPY, QQQs, as well as IWM. So the S&P 500 ETF, NASDAQ ETF, and Russell 2000 ETF. And so you have those every single morning before the market opens. And so that's a free newsletter that you can take advantage of. If you're someone who has a little bit more capital who wants to dive directly into our process, as well as some of the more explicit suggestions and callouts that we're actually talking about, you can just go to our website and take a look at some of our services there. Do you think Powell's hawkish? No, I do not. That was clearly a dovish report there by Powell. Alrighty, well, we're going to go ahead and end it there, ladies and gentlemen. I appreciate everyone for joining. And yeah, good luck out there, and we'll catch you in tomorrow's daily macro update. Bye, everyone.